Realty Income holds a lot of commercial real estate, and especially dividend investors love them because they pay out their dividend monthly. The stock has completely fallen in price to now $49 a share. It's back to 2015 levels, and at this point you gotta think, hey, it's probably a good buy at $50 now. It is now okay priced. I don't think it is a steal yet. First of all, the company itself is fairly safe. No client makes up over 4% of the company, so even if economic hardships happens and maybe one of two of their renters go bankrupt, the company itself will not be at risk. They're in so many different industries, they have so many different tenants, they're fairly safe there. But what is the issue then, Justus? Why are you not saying the stock is an extreme buy right now? We looked at the price, it fell to $50, the company's great, so it must be a buy right now. Well, let's first of all look at the growth. The CAGR is basically 5% every year. Sometimes it's a bit higher, sometimes it's a bit lower, but we can see on average it's 5%. It has not really changed much no matter how big the company got. 5% is not a bad growth rate, but it's also not very good. We always gotta factor that in our valuation later on. While yes, growth has been a bit faster lately, that is just because of low interest rates. Long term, that is gonna normalize, it's probably gonna come back down to 5%. And at the same time, they make around $1 per share in FFO right now per quarter, and they pay around $3 per year. So around 75% of their cash flow goes out in dividends. That means they have 25% to either expand their business or pay down debt. And now it comes to the important part here, the debt. Because I think the market is severely misunderpricing the risk here when it comes to refinancing that debt. Here we have all the debt that Realty Income currently has. They got fairly cheap loans. 1.8%, 1.6%, 3.2%. Basically nothing here is in the higher interest rates. The highest you get is around 5%. And we can see the maturity is fairly even. And we should also focus on the debt that we'll get from the Spirit acquisition. We can see their debt maturity is fairly even over the years. They will have to refinance all of this. Because remember, around 75% of their cash flow goes out in dividends. And that 25% will be used to buy new real estate, maybe do an acquisition, but it basically will be all used for the growth. The 5% growth is not gonna come from all of our old buildings. So when we now see that they're paying a very low interest rates on all of this, and they will have to refinance that eventually. And now we just say rates stay higher for a bit longer. Well, what will happen then? This massive amount of debt will severely impact their growth potential. While it will not bankrupt the company in no way, they could always just cut the dividend, but now I just want to look at the growth. They're currently paying $183 million per quarter in interest, while their funds from operations is around $700 million per quarter right now. So even if they just pay a slightly higher interest rate on those bonds, if they have to refinance all of them, maybe like 5% or 6%. Well, this 688 million will go to maybe 500 million. And now we gotta say, what does the market say? Are they willing to lend to Realty Income at very cheap rates? Here we have a Realty Income bond, which was issued this year, will mature in 10 years, which they managed to issue at 4.9%. Well, now the yield is 6.3%. So if they would have to issue new debt, the market would only be willing to lend to them at a 6.3% interest rate. This is for a long-term bond. With short-term bonds, it's the same, maturing in 2024, also trading at 6.3%. So I'm now looking at all this cheap debt, which will have to be refinanced soon, and even if the market is willing to now only give them a 5% or 4%, we can just look at the debt in 2027, 2028. This will all have to be refinanced at a very high rate in comparison. And here comes the risk. Can they even keep up that 5% growth rate with those high interest expenses? Because they took on a lot of debt. They have been going like crazy. Of course, a lot of this comes from share issuance, but net debt has also soared to now nearly $20 billion. While yes, they may continue to grow, but I don't think it's gonna happen at 5%. They have their Spirit acquisition, which is gonna be beneficial for the company in my opinion. Each Spirit share made around 93 cents in FFO last quarter. And the Realty Income shares made around $1. And for each Spirit share, they will get 7.62 Realty Income shares. So overall, that is a FFO positive for the company. I think they got a great deal. I think Spirit Capital investors had a fairly bad deal, to be honest here. But this alone is not good enough to give a 5% growth rate going forward. They currently make around $4 per share yearly. That had a growth rate of 5% and 4% for the next 5 years after that. 10% discount ratio, 15 multiple. For a company growing at 5 to 4%, that is not that bad. 74% payout ratio, little deduction due to taxes. That would give us an intrinsic value of around $54 per share, which is basically the current value. So if you believe this is gonna happen, basically the past is just gonna keep repeating itself at Realty Income, then yes, maybe you wanna buy it if you're just there for the dividend, want a stable dividend paying stock, have a bit higher yield than if you would buy treasury bonds, but I think that is mispricing the risk here. What I would say is realistic, slightly lower growth rates. 4% next 5 years, 3% after that, they just have a few headwinds, which they didn't have before. They achieved 5% growth in a time where interest rates kept going down. Now they're going up. And they're probably gonna stay a bit more up for a bit longer. While I believe maybe they're gonna be able to achieve a 5% growth, I wanna make sure that my investment will yield a good return. So I wanna be conservative, and that's not even that conservative, and say 4% and then 3%. Slightly lower multiple, well then we come to 48.10 per share. In that case the stock would be slightly overpriced. What if it goes even worse? Only 2% growth rate and a 12.5 multiple, which is what we're getting right now. Well then, $40 per share. In this case, we're getting like a 6% return right now. So while I think Realty Income is a good stock, especially for people who want reliable dividends, maybe retirees, but it is not my stock. Well, yes, I would love to get dividends every month. Right now, it is maybe decently valued if you just want that. But I'm not in need of monthly dividend income, and I think there are just way better risk-reward ratios, even in the REIT sector right now. So I'm gonna hold on, maybe if the stock drops even more, I'm gonna buy it. But right now, the risk-reward ratio is just not in my favor. What do you think? Many of you probably own Realty Income. Write it down below. Have a good day.